A new Fed chair just took the oath, Kevin Warsh. And if history is any guide, we might be about to get blindsided. Welcome back to TechMeHome, MarketPhase Daily News. Today's market gave us a mixed bag, gains on the surface, but underneath, warning signs that could reshape your portfolio in the coming months. Let me break down what actually happened today and why you should care. First, the headline everyone's talking about. Kevin Warsh is officially the new Federal Reserve Chair as of today. Now, for most people, this feels like a boring bureaucratic shuffle. They think, oh, just another Fed guy, markets go up or down, life goes on. Wrong. Warsh is not a consensus Fed guy. He's a hawk, a serious one. And here's the part they're not telling you. The last time a Fed chair changed before a major market crash was 2006. Jerome Powell took over from Janet Yellen in 2018, and we got a decent run, but Warsh? His track record is significantly more aggressive on inflation, which means fewer rate cuts and longer-term higher rates. That pressures growth stocks. That pressures tech valuations. That pressures anything that depends on cheap money. But here's the thing. Today the market actually rallied. All three major indices rose. Why? Because of geopolitical de-escalation between the US and Iran. Oil prices collapsed. That eased safe haven demand, meaning investors stopped buying bonds and gold and said, hey, maybe it's safe to buy stocks again. So we got a risk-on day. That's real, but it's fragile. Think of it like this. You're in a car that just hit the brakes hard. Then for a second, the driver eases off. You roll forward a bit. That doesn't mean the brakes aren't still engaged. Oil tumbling is genuinely supportive for equity markets in the short term. Lower energy costs mean lower inflation readings, which could theoretically give the Fed more breathing room. Theoretically. But Warsh doesn't care about breathing room. His entire philosophy is, keep rates higher, longer. That's the real tension here. And speaking of protecting yourself in uncertain times, a quick word from our partners at Vanguard Personal Advisor Services. If you're sitting in a portfolio that hasn't been rebalanced since 2024, you're carrying way more risk than you think. A Fed tightening cycle under Warsh could whip growth stocks around like a rodeo. Vanguard's tools help you stress test your allocations before the volatility hits. Use code TEXTME for a free consultation. Protecting yourself starts with knowing where you stand. Now, the good news today came from the banking sector. Q1 earnings were broad-based and strong. The FDIC confirmed that profit gains rippled across the entire industry. This tells us something important. The credit environment is healthy. Lending margins are fat. Consumers and corporations are still able to service their debt. That's bullish. It means we're not on the precipice of a financial crisis. Yet. But here's where I get concerned. And this is critical. Leveraged loan issuance is growing at the fastest pace since 2022. That's a yellow flag. Not a red flag yet, but yellow. When credit standards loosen, when banks get aggressive about who they lend to, when leverage creeps back into the system, historically that precedes downturns. Banks get greedy. They start lending to weaker borrowers. The cycle turns. And suddenly, what looked like strength was just the beginning of a credit blow-up. We saw this before the 2008 crisis. We saw it before the 2000 tech crash. The same pattern. Meanwhile, AI stocks remain the bright spot. Erin, an AI infrastructure play, surged today on the back of a $1.6 billion Dell AI deployment deal. Let that sink in. A $1.6 billion contract. Single deal. This is the relentless corporate capital allocation toward AI. Companies are betting billions that AI adoption is real, and that the ROI justifies the spend. And the market is pricing that in. IREN up. Semiconductor stocks holding. The AI thesis is still alive, even though Bitcoin got crushed today. Bitcoin weakness reflects exactly what I'm talking about. Lingering concerns about Fed policy under Warsh. Crypto is a risk asset. It thrives when rates are low and money is cheap. Warsh tightens. Crypto suffers. That's the game. So what does this mean for your portfolio? 3 things. 1. Don't get fooled by today's rally. It's on the back of geopolitical relief and oil weakness, not fundamental strength. 2. Watch Warsh's communication style obsessively over the next few weeks. His first speeches as chair will telegraph whether the Fed is genuinely committed to higher rates for longer. 3. Banks are strong, but credit is loosening. That's a mismatch. Eventually one of those reverses. The week ahead matters. We're heading into a data dump. PCE inflation, durable goods, consumer sentiment. Any of that could spook a market that's suddenly nervous about a hawkish Fed. You're also going to hear from other Fed governors. Their tone will matter. Are they backing Warsh's hawk stance or trying to moderate it? That's the real story. Here's my take. Today was a relief rally on geopolitical news, but the structural story hasn't changed. We have a hawkish Fed chair, loosening credit standards, frothy valuations in tech, and a market that's one bad inflation print away from reconsidering whether equities are attractive at current prices. Stay alert, stay positioned for volatility. And remember, none of this is financial advice. This is purely for entertainment and educational purposes. Always do your own research, talk to a qualified financial advisor, and never bet money you can't afford to lose. Thanks for watching TechMeHome. I'll see you tomorrow.